ETF taxes versus mutual fund taxes. This could be the last of our, I think, 4-part series on how ETFs are so much more tax efficient than mutual funds. And it's going to be fun to watch this because I'm actually going to show you copies of 1040s tax statements now and projected in the future using an ETF versus a mutual fund, and it'll blow your mind. So welcome to Heritage Wealth Planning YouTube channel, my friends, the place where you come to learn about exchange-traded funds, mutual funds, taxes, and investments, the whole kit and caboodle. When you're looking financial planning, this is the place you come. So don't forget to subscribe and, of course, comment. Always welcome comments below, and there's a little bell to hit as well to be notified for future content. All right, so I'm excited to share this one with you. So let's jump right into it. And as is what we do, we go to our Right Capital software here with Bob and Jane YouTube. Bob and Jane YouTube on Right Capital. And this is going to be fun, actually. This will be a good time. So I'm looking forward to sharing this with you. So what we've done here, I've changed around just a little bit because before in the previous financial planning tutorials, I had them each with $250,000 in their 401ks. Now I just switched that out. They don't have the 401ks. They each have $250,000 in a taxable account. All right. So all we're trying to do is see the tax ramifications on a non-IRA account of an ETF versus a mutual fund. And so that's all we got. So their net worth is $250,000 for Bob, $250,000 for Jane, and a $400,000 house. That's it. They're going to get some Social Security income, and that's literally, we're not doing a financial plan here, my friends. We're just doing some simple tax planning. So what we're going to do, in fact, let me just show you real quick. If we go to profile, I'll show you. If we go to investment, I just want you to see. So what we're going to use the Vanguard Total Stock Market Index. Now, the fund itself and what I'm going to show you here is irrelevant. We could use the VTI, which I think that's the Vanguard Total. Is that the Vanguard Total Stock Market ETF? I think it is VTI. Don't quote me on that. But either way, the VTSMX and the VTI, one and the same thing, except one's an ETF and one's a mutual fund. And if you've been watching any of the previous episodes, you remember a mutual fund has distributions, capital gain distributions that you have to pay. The end user, i.e. the investor, gets hit with those distributions each and every year, if there are any, and there will be some for sure, each and every year, and you got to pay tax on that. And that's just a fact. An ETF does not have that same. The way the ETFs are structured to allow them not to have to send their capital gain distributions that they send to you. So what we're going to do here is we're going to go up here and we're going to go to expenses, and we're going to go to taxes and fees, all right? And we're going to say, we're going to use a portfolio turnover of the Vanguard Total Stock Market Index mutual fund of 5% because an index fund typically has a pretty low portfolio turnover. We're going to say 5% for both Jane and Bob YouTube. All right. So that just means they have 100 stocks, 5 get sold over the course of the year. That's it. That's a tiny turnover. There's some portfolios that have 80%, 90, 100% turnover, which means they're selling the entirety of the holdings each and every year. And that could be a pretty big tax hit. But if you remember, the difference between 0 and 10% turnover is actually greater than the difference between 10% and 100 in terms of tax ramifications. It's actually pretty amazing. And I did the video on that a couple of days ago with Rob Arnott, where he said he and his crew at the research affiliates did studies that say if you have a portfolio with no turnover, i.e. an ETF, the portfolio with 10% turnover, let's say it costs $50 in taxes. If you go from a portfolio of 10% turnover to a portfolio of 100% turnover, it might cost $40 more in taxes. It's actually pretty amazing. So from 0 to 10 is 50, from 10 to 100 is 40. And both are tax inefficient, but it's just interesting that the more having the 0 is the most tax efficient by far. I thought that's pretty interesting. So, and I'll show you what I'm talking about. All right, so what we're going to do is we're going to go to retirement. I want to show you what we're looking at here, and then we'll go to the tax table, which I think you'll find interesting. And so what we see here, we're going to go to cash flows, all right, and we're going to go to taxes. I need to get my trusty, here we go, little thing. All right, so what we're going to show you here is tax payment. Now, remember, they have a 5% portfolio turnover. And see, they got basically no this tax right here in 2020 wipes off that tax right there of 2019. Don't know why it does that, but it always seems to have like for 1 year, the tax payment always is like 1 year behind. It's weird, but whatever. It wipes itself out. So we don't pay any taxes until 2020. And then we start paying a little bit of tax, 347 whoop-de-doo. Then we start paying start getting more and more tax. We pay $1,100 there, and then we start paying right down there, 2040. Actually, 2038 is where we really start getting hit with the taxes. In 2038, where we get 10,000 there. So basically, we're going to say 10, 20, 30, 40, 50, 60, 70, 80, 90, 110, 130, 150. That's basically 100. Was that 160? 100, roughly, all said and done, roughly $160,000 in taxes. Now, here's our income flows. It's just, again, Social Security. That's all we got, Social Security. All right. Now, there are no required minimum distributions because this is all in non-IRA, non-401k accounts. We are saving our unsaved cash flow. So we're spending it, I should say. We're just using that on whatever. We can buy whatever we want. So we're not reinvesting the portfolio, if that makes sense. So we're just spending it. We're not reinvesting into the account. Because what happens is we got $40,800 of income, $36,000 expenses. So we have a little bit more unsaved. We have more income coming in than going out. So we're just saying instead of reinvesting that, we're saving it. Instead of reinvesting it, we're spending it. Excuse me. We're giving to the church, maybe giving to the kids, whatever. And that's just what that column is. Now what you see here is we only have 63,000 coming in, and we got 56,000 going out plus a tax payment of where was that? Right here, 63 coming in, 56 going out plus a tax payment of 7,900. So we have $482 of negative cash flow, and then we hit here 2039. We only have 43,000 coming in, but we got 56,000 going out, and we got $9,000 of tax payment, which means we have a negative cash flow of 21,000. So isn't that interesting? Our taxes down. Let's see, 2040. 44,000 coming in, which is significantly lower than we had in 2038. But we have 57,000 going out with a significant tax payment of 29,000. So our net cash flow is negative 42,000. So let's think about that. What could have possibly caused a drop in income right here? Any guess? The drop in income, what could possibly cause that? Well, that is when Bob died and Jane took over everything. And that is a widow's tax trap right there. Less income, significantly less income, by the way, significantly more taxes. That's just how the widow's tax trap works. So let's go over the tax form. I want to show you something here. Oh, actually, I'm just curious. Let's go look at accounts and we'll see what the end result is. So they have $3 million when all is said and done, $3.02 million when Jane dies in 2046. All right, so they're still doing fine. Don't get me wrong. $3 million when Jane dies in 2046. All right, so I'm just writing this down. Our net worth, our account value, $3.029 million. All right, so let's look at a tax form. I want to show something to you because I think you'll find this interesting. Now, if you look at this, I love this visually. You see zeros down here across the board. Then we hit 76 and still basically less than 1%, pretty low. And then we take a pretty big rise from 81 to 86. And then look at that. That's the widow's tax trap, my friends. Look at that. It goes from 7 to 12.4%. That's horrible. But before we go into that, I want to jump into the 1040. All right. So let's watch this. So remember, we got a 5% capital gain distribution. All right. And so we can know just by looking at this schedule, line item 13 on the 1040, how much our portfolio is worth. We just take our trusty calculator, we take $25,000, divide that by 0.05. And we know for a fact that if we have a 5% distribution, which gives us $25,000, we're going to have $500,000 of portfolio. That's simple. You just take the capital gain distribution, divide by whatever the turnover is. In this case, is 5%, and we know we have $500,000. All right, we don't even need to look at the statement. We can just see that. So we have $25,000 of capital gain distributions, line 13, and line 8. Not much, $36 of taxable interest. And in line 9, we have about $8,800 of dividends, of which 85% is qualified dividends. So it's only taxed at the 15% bracket or zero, depending. And we're going to dive into that right now, as a matter of fact. So we do have $40,000 of Social Security. But yet our total income is only $41,000, even though we already have almost $41,000 Social Security. Why is that? Well, because only $7,221 of our Social Security is taxable because we're in the lower tax brackets of the provisional income things that you got to remember. And we'll get into that here too. But we actually have 8,000, we'll say 9,000, 34,000, That's at 41, so was that $75,000 of income, but we're only paying taxes. We're only showing to the IRS 41,000 because this right here is only subject to 7,221 is only subject to taxation because the tax code is very favorable for Social Security as long as you plan it right. So let's go down. We got 41,000 of income. We subtract out our standard deductions, and we got $15,000 of taxable income. But our tax line 44 is showing zero. Why? Wait. Josh, I'm married filing jointly. I have $15,793 of taxable income, that would still keep me in the 10% tax bracket, which I'd have to pay $1,579, but I don't show anything. I'm not showing anything in terms of tax. Why is that? That doesn't make any sense. There's a big mistake here. And the answer is, let's go look at the Schedule D. All right, so the Schedule D will show us the capital gains that we have, and it's showing us here we have $25,000 of capital gains. Net long-term capital gains, $22,500 for whatever reason. But anyway, that's what we're showing. We're showing capital gains of $25,000. But when you fill out this Schedule D, you come down, it says, do you have qualified dividends on Form 1040? Yes, we do. You need to complete the qualified dividend capital gain tax worksheet. Now, I want to be very clear here because this is crucially important for you to understand. When you have that tax worksheet, this right here is not reflective of your true taxable income. If you just look at line 43 on your 1040, and next year is going to be different, you could be grossly mistaken on what your actual taxes are. So let me bring up this right here because this is what's called the long-term capital gain, qualified dividend capital gains tax worksheet. And you fill this out. It's pretty easy to do. And you can see I've made some, I had to do a couple different ones, so I crossed some stuff out. And it's not that hard. This, my friends, is the determination of what you see here for your tax for line 44. Not this right here. Believe it or not, line 43 will show you something that it's literally irrelevant to what the qualified dividend and capital gain worksheet will show. And this shows we got zeros here, and I know you can't really see that, which means we put zeros there, which means we have no tax. So if you're just looking at this to determine what your tax rates are, you need to think again, because if you have up here qualified dividends and capital gains, you don't have any tax. You might not have any tax. It depends on where your bracket is. So right now we are in a 0% tax bracket, even though we're showing we should be in a 10%. Hope that makes sense. So let's keep going forward. We're going to go to, let's bring up to 2038 because that's when Bob died. So let's go to 2038. Here we got taxable interest of $20,000. Well, first scenario, we're going to say we have $49,957 in long-term capital and capital gains. So it's $49,957 divided by 0.05, which means our portfolio is almost right at $1 million even. It's actually $999. If you can see that, $999,000. So we know what our portfolio size is. Now, I am using I was using a 5.5% earnings growth plus a 2% dividend. So I'm using a gross return of 7.5%, but there is a 3% inflation. All right. So we're inflating the inflation is 3% and our portfolio is giving us 7.5 gross. Take the 7.5 minus the 3%. Our real return is 4.5. But all we care about in this case is just what's the growth of the portfolio, and also what's the growth of the tax brackets because those are indexed for inflation. So we got $20,000 of taxable interest. We got $22,000 of dividends, $50,000 of capital gains, $65,000 of Social Security benefits, of which the vast majority is taxable. So here we have $148,000 of total IRS income, but we still have really about $160,000 when all said, because we're only getting a $10,000 reduction in taxable income from our Social Security. So we come down here, $148,000. We got our standard. We don't have the same standard deduction as we do now because the Trump tax bill is expired here. We're going back to the Obama taxes, which we have a pretty still decent standard deduction, still got some exemptions. So our taxable income here is $110,000. And again, that's pretty close to 10%, even though taxable income of $110,000 would put us in the 22% tax bracket. All right, so we have a 22% tax bracket. We're really only paying 10% on that because capital gains and qualified dividends are only taxed at 15. So that's the benefit of capital gains and dividends, that they're taxed so low relative to ordinary income, relative to your taxable or your 22% tax bracket. So you're like, I got 110,000 taxable income, only paying 10,000 taxes. That's a 10% effective tax rate. And that's absolutely right. And again, the reason isn't because you're not in the 22% tax bracket, because you are. It's because these two guys right here. But I want to show you something else. Let's go back a couple years. Let's say 2034. All right. So 2034. This is interesting. This is fun. Again, we have $12,000 of taxable interest, $20,000 of dividends, $41,000 long-term capital gains. And if you can figure that out, what's 41 divided by 0.5? Probably was that 900,000, I think. 41 divided by 0.05 or 820,000. We have Social Security benefits of roughly 60,000. We have, of which only 20,000 is taxable. So we have $112,000 of seen income from the IRS, but we really are living off 132,000, because 20,000 of this is not being subject to taxation. Come down here, have 120,000, 112 is our AGI. Subtract out our standard deduction, subtract out our exemption, and we have a income, taxable income of only $78,000. Does that mean anything to you? Well, what that says is, because we're only having taxable income of $78,000, we're still in the 12. In this case, it'd be the 15% tax bracket, because again, the Trump tax bill has sunset. But the Bush tax law, if you're in the lowest two tax brackets, you don't pay anything on capital gain. So we aren't paying anything on this right here. We're not paying anything on that. Not paying anything on that. We're just paying a little bit on that right there. And the difference between these two is about $3,000. We're paying taxes on $15,000, give or take. That's it. So we have almost $40,000 of income, but we're only paying $2,500 in tax, because long-term capital gains, qualified dividends are not subject to taxation as long as we maintain in the 12%, or in this case, a 15% tax bracket. 130,000, 140,000 income, only paying $2,500 in taxation. That's incredible. No other way around that. If you don't see the value there, we got to rethink things, because that is amazing value. All right, so now let's go to 2040. This is when Jane had survived Bob, and this is when it starts getting ugly. All right, so now now remember, so Bob dies, Jane inherits, she just takes over his account. All right, so now all that she has is all in her name. So now she has $72,000 of capital gains. Divide that by 0.05. Her portfolio is $1.44 million, $23,000 of dividends, $25,000 of taxable interest. Now she loses Social Security. She loses her own, but she gains Bob's, or vice versa. She loses the lesser of the two, and she's paying tax on 85% of that benefit. So her total income is about 165 or so, of which 158,000 is seen by the IRS. Come down here, 158. She only has one standard deduction. She only has one exemption. So her total taxable income is 138,000, which puts her well above. That's probably into the fourth highest bracket. And now she's paying taxes on this, on qualified dividends at 15%, paying taxes on this, capital gains at 15%. The vast majority of her Social Security is taxable, 85%. And now she's paying a whopping $20,000 in taxes, even though she doesn't have that much more in income. In fact, later on, she'll have less income with more taxes. And that's, again, the widow's tax trap. And that's what you need to avoid, because what happens is the triple whammy. You've made this taxable, qualified dividends now taxable, where before it was not. Your capital gains are now taxable, where before they were not, because you're married filing jointly. You're still in the 12% tax bracket. You're making more of your Social Security taxable, where before less was. And then finally, you're in a much higher tax bracket as well, making more of your income subject to a higher income tax. The widow's tax trap in just right there. That's exactly what it is. So now I want to try something. I want to show you something different. Let's go. I'm going to show you what the difference is between a 5% turnover, i.e. a mutual fund, and a 0% turnover, i.e. an ETF. Because remember, ETFs, the turnover doesn't go, the capital gains don't go back to you. All right, so that's all I've done. That's all I've changed. Now let's go to retirement. We're going to go to cash flow right here. And we're going to hit and watch this. We're going to look for tax payment. Again, these two wipe themselves out. I still, for the love of me, don't understand that. But watch this. So now we have nothing until 2034. 2035, we have 5 In 2036, we got 800. Until Bob dies in 2040, we basically have no taxes. We got 15, what's that, 30, 45, 60 roughly, 75, 90. We have 105. So we saved $55,000 in taxes solely on having no capital gain distributions. $55,000, my friends. Now let's see what the account's worth. Remember, before it was worth 3.029. Now it's worth 3.110. So we saved, that's almost $100,000 more that we have in assets available for future use for your, whatever you want to do. Now remember, a couple things. We're not even reinvesting these things. All right. I guess, let's try it. Let's just go ahead and reinvest these guys. I wonder what that look. How do I do that? I can't do it from the screen. I got to actually go back to the main screen. I can't. It's too bad. So we're not even reinvesting these. We're actually doing, we're spending the excess cash that we're getting. And that's fine. But if we reinvested them, it'd be even more beneficial because you have less taxes. That means you have more money to use to reinvest at that 7.5% gross. It's sickening, actually. $100,000 more. Nothing has changed. The risk of your portfolio hasn't changed. Nothing has changed other than the fact there are no capital gains. So let's go and take a look at the tax. I'll show you exactly what I'm talking about. I do still love the visual. So here, look at that. 0%, zero across the board until we hit 81. Then we got 1.4. Then we go up the big tax to 11.4 when Bob dies. But still, look at that. All right. It's insane how little taxes there are, even though how much income we're going to get. So here in 2019, we got $8,000 of dividends, no capital gain. Look at line 13, no capital gains, my friends. We got 40,000 Social Security. Look at that. None of it's taxed. 40,000 Social Security because all we have, we have no income. Look at that. We're showing $8,872 of income because none of our Social Security is taxed. Why is none of our Social Security taxed? Because our provisional income is zero, essentially. And we have no provisional income. If you remember the provisional income rules, if we have less than 32,000 married, filing jointly, we have no Social Security subject to taxation. And we do. We have 8,872 as provisional income, which is well less than 32,000. None of our Social Security is taxed, which means we are in a 0% tax bracket, which means none of this is taxed. And we got $50,000 of income. None of it's taxed at all. And all we need is $36,000 to live on. And you can play these numbers any way you want. Look at that, though. Nothing is subject to taxation. All right, so let's fast forward to 2000. And in fact, we just look at the sheet again. We can look at Schedule D just to show it. It's literally just zeros across the board. Remember, before we had 25,000, now we got zero. Here's a qualified dividend tax worksheet. Yes, we do have qualified dividends, but we have nothing to fill. So all that just flows back to 1040 and we have nothing to show. Let's go to 2034. And let's see what we look like here on the, I got to go back to 1040 and 2034. And let's see what we look like here. All right. So here we do have a little bit more of dividends. We have a little bit more taxable interest. Again, a big fat goose egg for line 13, which is going to capital gains. 59,000 Social Security, of which only 47,000 is taxable. So here we got, let's say 60,000, 70, 80,000, 92,000 bucks, of which the IRS is only seeing 36,000 as total income. We take our $36,000, we reduce it by our standard deductions, we reduce it by our exemptions. We have $2,400 of taxable income, of which we only pay 10% on that. So we have almost $100,000, of which only taxable income is $2,400. That's it. And we're living well beyond that 100,000 simply because we have no debt. And again, everything falls on the expenses, but look at that. $100,000 of income, roughly, $2,400 of taxable income. That's it. All right, so let's go to 2038, and that's the year Bob dies, if I'm not mistaken. Okay, he died in 2039. So the same thing happens here. We got 65,000 social. We got 21,000 roughly. That's what, 86,000, 9,600. That's $110,000 of income, my friends. We're showing to the IRS only 57,000. We become 57. We subtract our standard deductions. We subtract our exemptions. We have $19,000 of taxable income. We pay $2,000 in taxes on 20,000 of income or something like that. It's insane how beneficial the tax code could be if you learn how to play with this. All right, so let's go to 2039. That's where I wanted. That's Bob's now gone. Yeah. All right, so now we got, watch the difference here. All right, so now we have we do have some capital gains. Why do we have some capital gains? Because we have to sell some stuff because we have such a big tax payment that Miss Jane has to sell some stuff to order to pay the taxes because she has $7,600 of taxes. Now, a couple things going on here. Remember, we're only inflating Social Security at 2.6, but we're inflating expenses at 3% as well. So her expenses are growing just steadily more and more than her Social Security is, which is real life, by the way. And so her expenses are slowly creeping up to the extent now she doesn't have nearly enough money to cover expenses and the taxes. So she has to sell some stuff to cover the taxes, which increases her taxes even more. So we get $81,000 of total income we're showing, which is roughly $105,000 of total income because the bulk of her Social Security still is not taxed. But $101,000 of total income, she's still paying $7,600 in taxes, which is significantly higher than what she and Bob were paying before. All right, so lastly, let's just go to we're just going to pick about 2044. It gets progressively worse. Now, 85% of her Social Security is subject to taxation. Huge capital gains because more of her stuff is taxed, which means she has to sell more of her stuff, which means she's going to have more tax. You can just see the whole thing. We got, $14,000 of taxable income. And this is what's going on. And not because of capital, well, it is because of capital gain, even though there isn't one from the ETF. It's just because she has to sell stuff to match the taxes that she has because of the widow's tax trap. It's just as bad. So either way, though, at the end of the day, if we go back to the retirement, the facts are still paying a heck of a lot less tax than she was before. But when she is a widow, she pays more. There's just no getting around there. Here's the tax. Here's the income, total income, $44,000 coming in, $57,000 going out. She has to sell some stuff to cover it, which means her taxes are there. It's a vicious cycle, and that just progressively gets deeper and deeper and deeper until she dies when she's 90 years old. It's just bad, but it is what it is. And we looked at the accounts, which was $3.11 million, which is still $100,000 more than the 5% mutual fund. The end of the story here is the facts are, if you want less taxes, less of a widow's tax trap, she's still going to face a widow's tax trap. You need to have ETFs and a non-IRA portfolio. There's just no getting around that. Total stock at Vanguard versus the Vanguard ETF is a Vanguard ETF 100 times out of 100. There's just no getting around that, in my opinion. Now, you'd seek your own opinion on that for sure. Lastly, I didn't talk about this because I don't know the system won't allow us to do that where you have a step up in basis. But remember, what happens here, we go to dashboard. When Bob dies, yeah. All right, so when Bob dies, this right here, whatever it's worth at his death, will be inherited by Jane with 100% step up basis, which means whatever this value will be, Jane will get 100% of it, and it won't be taxed at all because it's what's called a step up in basis. And that is we're not showing that in the system because I haven't figured out how to get the system to show it. In fact, I don't think it can. All right, so just remember, though, we are showing a little bit more dramatic tax-wise because Jane will inherit Bob's taxable account and not owe any tax on it whatsoever because of the step-up in basis. If you live in a common law property, that will be true. If you live in a community property, community state like Texas, California, a lot of states out west, if you got to talk to your tax guy, but in particular, you want to talk to a real live attorney. If these are held in trust, living trust, not a irrevocable trust, living trust, this is like 10 years ago since I read this book, but my understanding is, I'm not an attorney, but you should look out. If these are held in living trust and it's a community property state, does Jane inherit the entirety tax-free? Not just Bob's share, but the entirety with a step up in basis. And that was my understanding. If that's true, then what you'll see here for tax will be, details, will be zero right here. These are the tax she has to pay, and she has to pay it because she had to sell stuff to cover her deficit from Social Security and her expenses. And these were subject to 100% of a sales price of a capital gain. That will not be the case if she a community property in a living trust. And half of this would be the case in real world if that she was able to inherit it from Bob. I didn't even mess around with that. I can manipulate it. It's just, it loses some of the burden if we have to go down that far, because it's going to bore people to death. But that is the benefit of community property estates versus common law, and potentially of having a living trust as opposed to just having it joint tenants with right survivorship. I highly encourage you to seek legal advice on that for sure, because I'm not an attorney and I just read books, and that doesn't make me any more smart than you. You can read books too, but that would be a big deal for sure. Anyway, hope this helps, my friends. Stay tuned. We're rolling out a new website. Just rolled out today. My man Dave up in Pennsylvania. I'm happy to give you referrals of your referral to him if you're looking for a website